You from the new station in St. Louis.
Welcome to HomeWise. I'm Stal Ponticus, the creator and host of HomeWise, Michael Midget. If this is your first time joining us, welcome aboard. We are glad that you're here. Michael, good to see you, buddy. How are you?
I'm good, Stal. How are you?
Doing fine, thanks.
I love these days, let me tell you.
I know you got a lot of stuff to cover here today, so we'll jump right in.
I try to pick a little bit of variety, so we try and hit a little bit of everything, try and get for, a wide range of people, not just people that are looking to buy or sell their home or finance their home, which pretty much today is only going to be those that are looking to buy or sell. But, there's an entertainment aspect to it also, but then there's also a news reporting aspect, and then there's an informational aspect and all the things. And so, you never know why somebody might purposely tune in, much less the ones that just kind of happen across you on the radio dial on these lovely Sunday mornings.
Mm-hmm.
So today we are going to hit on discrimination, right? Okay. But not the way that you might, think in a legal protected class sense. Instead, we are going to talk about self-employed borrowers. And when I refer to self-employed borrowers, especially when I'm talking to another self-employed person, because I'm a self-employed person myself. I've been self-employed or counted as self-employed my whole entire life. So I know a thing or two, not only about being one, but qualifying them for financing. And for reasons that we will get into here in a moment, I feel that they're discriminated against, unfairly discriminated against. So, you're always going to have some level of discrimination because you have to make determinations, pick and choose. Like some people are qualified, some aren't. And why aren't they? And that's, I guess at a core foundational level, that is count as discrimination because you're discriminating. You're saying, these can have it, these can't, and that. But this is a little bit different. And so let's, when it comes to income qualification. So here, let me ask you a question.
Mm-hmm.
All right, pop quiz for Stel today. What do you think of when I say self-employed borrower? Like, what comes to mind?
To be honest with you, probably my dad, since we had a family restaurant business.
Okay. All right.
Would that qualify as self-employed because he was the owner of the restaurant?
If he is the owner,
he'd have to go to the bank to get the loans. He would be the one responsible for everything financially.
Right. And so, yeah, it comes down to ownership. So it doesn't really matter what your role is in the business. You could be an active partner or a silent partner. If you're going to use that income is going to fall into a self-employed category. If the entity from which the income is derived, you are 25% or greater owner of. Okay. And so you're right, but you're exactly right. So your father owned a restaurant.
Correct.
Right. So that's clear. Anybody that owns a business. So if you have a business, like a store, a storefront, a building, you get up, you go to work, that place where you work, you're the owner. It's your business. If it's a corporation, you own the capital stock with that. If it's a limited liability company, you're a member of it. Like the literally technical on paper filed. Or unfiled. I guess here in Missouri, we don't file the articles for the LLCs or the corporations. But somewhere there's a legal listing of the ownership. If you appear on there, technically you would be considered a self-employed person. But what about some people that you may not think of as self-employed, or maybe we should say not think of as business owners, but they're also not a classical employee, right? So how about a plumber?
Yeah.
Guy's got a truck, right? And he drives around and he plumbs, plumbers, that's what plumbers do. Great job, too, by the way. It's really hard to find a good plumber.
Boy, it sure is.
And recently I found a good plumber, so I'm happy. when we get to a certain point here where
When you had your kitchen incident?
no, this was the I've had a couple of they say incidents happen in threes. So we're on incident number 2 now, so I'm just waiting for the third hat to drop. Which, I don't know. These days, apparently UFOs are real now. So, I don't know what to listen to. And we're going back to that sort of uneasy feeling that I've had.
But plumbers are good guys.
Plumbers are good guys, and they also make a good example for this, because you could be so you're a license, like a plumber, right? So you're a real plumber. You have a license. And maybe you work for a plumbing company, which you would be an employee. You would get a regular paycheck. The end of the year, you would get a W-2. Technically, for legal purposes, on the payroll of that entity, you are an employee, and you have no ownership in that. No ownership, capital ownership in that company. You're an employee. Right, so that falls under the normal categories, and we talk about income and qualifying. That's the category that I generally talk about. To whatever you make, that's what goes on the application. Now, let's say that instead of that, though, maybe he is let's say a self-employed business owner, but that doesn't count because you can't use the word in the definition that you're trying to define. So he doesn't work for a company. He works for himself. He's got a listing on, Angie's List or Home Advisor or whatever other home services lead aggregation service that I do not like. Mm-hmm. So I don't promote. So not intended for that. Just so everybody knows what I'm talking about here. You put a listing up there, XYZ, Bob Smith Plumbing. Your drain's clogged, give me a call. So he gets a call. Hops in his truck, drives out there, plumbs it. They pay him, right? He is his own entity in that sense, even if there is no entity, right? So he might be a sole proprietor, right? That's self-employed. Now, another example might be plumber who he had more aspirations, or maybe over time he started out with just him in a truck, but now 10 years later, he's 20 guys with 20 trucks. And he employs other plumbers, right? So maybe he still plumbs, maybe he doesn't, but he now owns a plumbing business that does plumbing for a living, and he hires other licensed plumbers to come and do your work. Clear your drains, fix your faucets, install your pipes, whatever you might need done. And so now that is obviously clearly self-employed. He's a business owner. You can, it's XYZ, Plumbing or Bob Smith Incorporated or LLC or whatever the case might be. Bob Smith with a truck on his own, just a guy driving around doing this for himself. Big corporate conglomerate, nationwide, board of directors, has a set of owners. Those guys are also self-employed. Same set of rules are applied to both, right? That's where the word discrimination for me comes in against. I think that, and this is my accounting background and my make sense, common sense way of looking at things kicking in here, is that those are not the same situation. Why would you try to apply the same set of rules in both, right? So what do those rules look like? So we kind of discussed this a little bit. It's wage earner, paid on a W-2. That's the employee thing. The other side of the coin is the business owner. So it's generally you own 25% or more of a business, and you aren't a wage earner, or paid on a W-2. Mm-hmm. If you fall into that category where you're going to be classified as self-employed, you need 2 years. You need to be in business 2 years. That activity has to be, quote unquote, on the books for 2 years, which basically means you need to have filed 2 tax returns. Okay. And the business needs to be at least 2 years old. You'll need to document the age of that business using either tax returns, because tax returns carry a lot of weight in the underwriting world. I figure if you're going to represent something to the IRS and they haven't thrown you in jail for that representation, then it's probably true and real. We could rely on that to document whatever it is we're trying to document. In this case, existence of a business, the date that a business started, and financial figures associated with that business, basically revenue, expenses, net income, and the taxes that you're going to pay associated with that. That all legitimizes this, this activity. So you need 2 tax returns filed with them. And it could be so when I say tax returns demonstrating that activity, right? So in this case, if we're going to use the plumbing example, he would have, if it's just the guy with the truck and he's a sole proprietor, he might file that on a Schedule C, right? Schedule C is a part of your personal return. And so you'd have 2 years of personal returns. And somewhere on that personal return, you'd have the Schedule C items. That's basically your profit and loss statement for the year associated with that business. All right. Or if you're a separate entity, a corporation, an LLC, and you're electing to be treated as a separate entity, meaning you're separating that business activity from your personal financial activities, right? Just means you're going to capture that on a separate tax return, all right? So that might be an 1120 for a corporation, whether it's a C Corp or an S Corp or whatever, doesn't matter. Or on an LLC will either be a 1065, which is your partnership return, or it could be an 1120S if you take in the election to be taxed as an S Corp. It gets complicated, it gets complex. My intent here is not to explain any of that, so none of this is legal advice. I'm just kind of throwing the terms out there because I know people will listen to this and they try to self-select and figure out which box they fit into, right? That's the job I'm trying to do when I talk to somebody. So I'm asking questions, and sometimes they're just the most obscure, weird questions like, well, how do you get paid? Who signs your check? Whose name is on the check? Are there check numbers on the check? Is there a stub attached? Does it show previous, what does it look like? Because there's all clues there with that help to, I guess, define what that relationship is, because it's really, at the end of the day, it's what that relationship is as to how it's going to be classified. And then how it's going to be classified is how the income is going to be calculated and what documentation is needed to, I guess, support or prove or legitimize those figures that we're going to use. So it becomes a big deal. When you think of this, income is, for qualification, that's where we're figuring out debt to income ratios. In a theoretical sense, that's the ability to repay, right? You have the ability to make the payment that we're trying to qualify you for. In order to believe that you have the ability to pay it, we need to see income. We need to see proof of cash flow. You have to have something coming in if you're going to turn around and pay it back out. And then we need to understand the nature of that, everything that goes along with that, because not only are we trying to ascertain what that number is, calculate it, quantify it, but we also need to qualify it. Qualifying meaning, in a sense, as to the nature of it. So how stable is it? It really comes down to stability on that other side of the coin, right? Stability of income. It's great if it's there today. What about tomorrow? What about next week, next month, next year, 3 years from now, 5 years from now? Because, see, you're trying to take out a 30-year fixed loan. And today, those loans might be on the books for a while. So, yeah, I want to make sure you can make those payments today, but I need to make sure you're going to make those payments tomorrow. And when you are employed by someone else, that, I guess, responsibility to pay you for what you're doing rests on somebody else. And so, an underwriter's ability to quantify that and scrutinize that is limited. right? Because they're not going to have you go to your employer and say, hey, I know I just work here and all, but, I'm trying to get this loan, and this underwriter, he's really worried about, your company. He wants to see how stable you are, right? Well, you think that doesn't happen? If you work for a mortgage company, right, an underwriter will see that, and they see what's going on in the industry now. If you're a real estate agent, they see what's going on in the real estate industry now. Let's say you're in title, you're an appraiser, you're an inspector, you're somebody whose income is primarily derived from this particular industry that we know have proof is not doing as well now as it was in the past. What happens if we can already assume that your income is going to have gone down. Now, that's not guaranteed. It's not the case for everyone, but they would understand if it has. See, normally that would be an awful, terrible thing, and that would really give an underwriter pause, and that could be an issue with getting qualified if you show a declining income. Because if that continues to decline into the future, today you might be qualified for the payment, but next year, if your income continues on its trajectory down, you might not qualify for it anymore. And so then your ability to repay, so now then we fall back to that concept, could be impaired. This is what an underwriter does. This is what they're trying to do, is to figure out qualitatively, in a numbers sense, in a soft sense, are you going to be able to, is this loan going to stay good if we put it on the books because they're long-term, things. So when it comes to, I use that term discrimination, I understand that there are going to be differences and that there is more scrutiny that needs to take place, because we always want to make sure that we're making good loans, not just for the investors, not just for the market, not just for the economy as a whole, but also the people that you're putting into these homes. Because some people look at this and say, well, they qualified me for the payment, I must be able to afford it. Mm-hmm. That is, again, if you listen to the show, you know that I don't always subscribe to that notion. I say that typically I can qualify you for a payment that's going to be much higher than what you're probably going to be comfortable making. Just because, I put my accounting hat on when I first got into this business, and I looked at what underwriters would allow people to walk away with huge sums of money, and what their finances look like. I'm like, there's like no way. If somebody is at a 50% debt ratio where this new payment represents 50% of their total gross income, I mean, I'm thinking like, oh, he's got some taxes coming out of that. He's going to have some insurance coming out of that. And you can see it on the pay stub. It's like net pay, gross pay, net pay. Wow. And then there's like food and like other things that don't figure into that ratio. We're only figuring in debts on a credit report. So someone could have no other debt, but they still have other bill payments to make. Mm-hmm. So that's where we get into that. So question is, we're going to dig into that deeper here. Let's go to a break.
Okay.
And when we come back, we'll share more.
Good. You're listening to HomeWise. That's Michael Midget. I'm Stal Ponticus. Glad that you're along for the show this week. And we will be right back right after this break. Welcome back to HomeWise. I'm Stal Ponticus. Michael Midget is here, and we are in the middle of a discussion here on self-employed borrowers. Is that the way you would phrase it there, Michael?
Discrimination against
discrimination. That's right.
Well, we're liven it up here. You got to make it controversial, right?
Okay.
Isn't that...
That's right. You got to add.
You know more about all that than I do.
You got to put a little edge on it.
Exactly.
Okay.
Because if it has no edge, it won't cut through anything. And in fact, I heard this past week Tucker Carlson came out and had his first show on Twitter, mm-hmm. right? And interesting to reflect on what, not so much the show itself, but people's reaction to the show. And I think the overwhelming consensus was that they thought that there would be more fanfare to it instead of it just kind of popping up. Hey, what's it called? Tucker on Twitter. I think it's a great name because it's very simple and to the point, and it fits. It's all full of keywords.
Yeah.
Like when you're looking at digital marketing, because that's the world he's living in now, right? He's off network and he's out there in the sea of digital land, and it's a squishy world. It is. It's a squishy world out there. I mean, he's going to be fine, but
I had no idea that it was coming up.
Yeah. Oh, I didn't either. I heard it.
I missed it initially, so I have to go back to watch it.
Yeah. In fact, I heard it first from Mike here on the station, listening to his show in the morning, like I do all the time. So yeah, you gotta have something that that cuts through there. So, but no, this discrimination thing is real. We've kind of talked about some of that, why that is, and in what way that occurs. But basically, if you are, so remember I said you needed to be in business for 2 years. You're not in business for 2 years, SOL. Right? No loan, no loan. Versus if you were an employee with a salary, you could have just switched jobs or started a new job. And from day one or the day you get your first paycheck, you could be qualified using that income. So maybe you just got a promotion at work. Maybe you are working at the same company, you got a new job within the company. Maybe you got a new job and you left the company, but you're an employee, so you're going into a salary where you're getting a guarantee. That income can be used right away. But let's say that you left a job. Let's say you went from being an employee, a wage earner on their payroll, getting a W-2, to being let's say you go to a consultant, or that's what they call it, right? A consultant. You're essentially doing the exact same job for the same company. You might even be sitting in the same desk, using the same computer, logging into the same network that you were before. But on paper, you got basically moved off of their financial statements in a sense that you're no longer an employee there, and now you're going to be an independent contractor. You're going to be a contract employee, right? They might even call it a contract employee, okay? Why would a company do that, right? Well, it's not evil. It's not anything like that. There's pros and there's cons to it for both company and the person. But all of that aside, what it means is that you're no longer an employee and now you're self-employed. Because at the end of the year, you're going to get that 1099. And that 1099 is not the same as a W-2 because there's been no taxes withheld out of it, like from the company. And technically, the legal parameters that have to be satisfied in order for a company to properly classify you as an independent contractor and thus can be paid on 1099 and are thus relieved from collecting and paying payroll taxes and having to give you benefits that they offer to other employee, like that whole game there. Okay. Certain things have to be satisfied, one of which is you don't have a guaranteed position anymore. See, if you have a guaranteed position, that is more reminiscent of an employee. So when that comes to qualification, remember, back to stability, we don't have that guaranteed employment anymore. Well, now we need to see a track record. Well, how long of a track record? 2 years. Well, I just switched, but no loan. What? I mean, it's the same job, same company, same everything. I get this. I'm even using the same. I haven't even changed business cards yet. I'm talking to this. I'm doing the exact same job. Sorry. Tough. Tough. I know it sounds terrible. Tough luck, but I've had to tell people that before. And there are industries that are. Transient's not the right word, but when you look at it from the outside looking in and put on your underwriting glasses and you're looking at it, it looks transient, like nursing, for example. today we have a nursing shortage. Teachers to a certain extent, although teachers work off of, teachers will kind of bounce around also from year to year to year. May change schools, may change jobs within a school, promotions, based on what it is that they're doing. They might even be moved over to consulting roles, depending on the nature of what they're doing for the organization. But in nursing, it happens a lot too. So you'll see nurses bounce between W-2s and 1099s, independent contractors, and it just depends on which cycle do you catch them in. Do you catch them when they've just moved from W-2 to 1099, or from 1099 to W-2, and everything else is equal? You get a different answer from underwriting. It's a whole different set of things, and just go try to explain that to somebody. I get it. I understand. Your explanations are not wasted on me, and I apologize for the 9,752 questions that I just asked you to determine the answer that I just gave you, which was not favorable. Mm-hmm. Okay? Mm-hmm. Here's what we need. Here's what we need to do. We need to wait 6 months for you to get that next job and make sure that it's a W-2, right? And this is not specific to nurses. It's specific to anyone that is in this situation that does that. Okay. So, you got to have 2 years on the job. So to me, that's a form of discrimination. We're discriminating against them, not necessarily unnecessarily, but you are making a determination that may or may not be fair. It certainly doesn't meet common sense. So, when you're self-employed, so here's where that comes in, right? So let's jump ahead a little bit. And the example that I am thinking of for this is an Uber driver, right? So let's say that you're an Uber driver. And I think there's still 1099. I know there's a lawsuit or something coming, or has been going on for a while, that somebody, obviously the Department of Labor wants to classify them as employees so they can collect the taxes from Uber, right? Because the second that you push the tax-bearing responsibility onto the taxpayer themselves, now you're tracking down, 50,000. If they have 50,000, I don't know how many drivers they have, but let's say they got a lot, because they're everywhere. Let's say there's 50,000 of them. Do you, as the IRS or the Department of Labor, or whoever it is, do you want to chase down 50,000 people for $100 each? Or would you just rather go to Uber and say, write me the check for 50 million, or whatever the number, works.
Deal with one.
Right, exactly, right? It's easier to just go to Uber. Or the one entity. This isn't specific to Uber either. This might work for the plumbing company. That, example I used earlier, guy in a truck. Well, guy in the truck works for himself, but maybe when he got bigger, he's like, oh, I'm going to hire other guys with trucks, and they're all going to be independent contractors. I'm just going to supply them with the business, with the jobs. Because see, I got real good at going on to Angie's List or doing the marketing or whatever, and I got more pipes to clean than I can possibly clean in a lifetime. I need help. Oh, I got 3 buddies over here that are, they're getting ready. They just got laid off from their guy. Their guy doesn't know how to market or whatever, but I got work for them. So now I hire them to go do the jobs. And let's say if I'm getting $200 for the job and I'll pay them $100 to go out and do it, I can keep $100, and I didn't have to do anything but run an ad. Well, you got yourself $1 million. You got yourself $1 million business. You know how to do that. Because you can do that all day long. That will scale all day long. See, now he's got a real business. But that's a whole nother show. Intensely interesting concept, by the way. But those other guys, right? So now he's like, wow, this guy, I could quit my other job because I would have only been making like $37.50 there because it's a 1-hour job and I get $37.50 an hour from that guy. Well, he's going to pay me $100 to go out and do this thing for him. I could work half as much, still make more, and can get a new truck because now I got new money to get, new guy, new truck. All right. So he builds his business on the back of that. And so now this guy goes out to get a loan. Oh, yeah, I got a job. I work for my Bob Smith Plumbing over here. So we go to, here, well, show me your paychecks. Well, he gets a paycheck. It's like a check written out or a Venmo into his bank account or something like that. Like, okay, well, at the end of the year, he gets 1099 because Bob Smith's smart enough to have an accountant. An accountant knows you got to pay out, okay, I see what we're doing here, and we're going to check we're going to do this above board, and, you at least got to send him a 1099. So he gets 1099 at the end of the year. Okay, well, you're not employed, you're self-employed. Well, how long you been? Oh, I've been doing this for a whole year. Look, I made X, number of dollars. It's 3 times more than I would have made working for the other guy because not only does he pay me more, but he had more business for me to do, right? But can't use it because haven't been doing it for 2 years. But do you still work for the other guy? Well, no, I quit. That's how I made all the money. I had to quit that because, right? So you hear this story. It's very common. I'm not making it up. It's a compilation of other stories that I've heard over the years from people that are actually in these real situations, and it's given rise to alternative programs that we're gonna jump into here for just a minute. But let me touch on one thing because it's the common sense piece of this, and it's going to springboard into the primary basis and foundation for what all of the alternative income documentation programs rest upon, right? So what is the difference between getting a 1099 and a W-2? If it's the same job, and let's just even say it's the same money, you've been doing it for the same time, let's say you've been doing it for several years, right? You have a fantastic track record. Why can't I just give you the 1099 and have you treat it like a W-2? It's the same. It's the same money. Let's even say it was the same figure on there, okay? Well, here's the thing, is when you give me that tax return, because if you want to move forward, you're going to have to that's how we're going to verify this. If we're going to do it under conventional guidelines, the typical, the status quo, the good low rates that you see today. Well, compared to what you might have if you were in an alternative, not super high, but higher than, if rates are 6, they might be 7, 7.5, something like that. So you want the 6 before you would take the other. Well, when you give me that tax return, see, I'm not going to see, if your 1099 said 100,000 on it, I'm not going to see $100,000 of income there, because on the Schedule C, you're going to have these things called deductions, expenses. Because see, you also have an accountant now, because you looked at Bob, your friend Bob over here, who's running, he's a smart guy. Bob, when he brought me on here and saw I was making all this money, he was looking out for me. He's treating me like an employee. He's treating me like a friend. He's telling me smart things. He's like, you need to get yourself a tax guy, because a few things are going to change. Now that, in one ear and out the other, but you were smart enough to make the call when it got to the end of the year. He called his guy and he did your taxes for you. And so if he's doing your taxes for me, he used to do this for a living. What you're looking for is deductions, because why would you want to pay tax on 100,000 if you didn't have to pay tax on 100,000, right? So you got that truck. Well, it's your business. It's your truck. Your tools, your uniform, your gas, your mileage, your insurance, your whatever else you can logically attach to that business activity is going to be quantified, or could be quantified, put on the form as a deduction, and you might be able to conjure up $20,000, $30,000, $50,000 maybe in legitimate business expenses, so that you're not paying tax on 100,000. You might only be paying tax on 50. Well, I got the 100 though, right? Well, you don't get to count 100 for income in that 1099 example. You only get to count income of 50. Why? Because that's what the underwriting guidelines say. Now, legitimately, you had those expenses, because we're certainly not suggesting that anyone fraudulently filed tax returns or anything like that. or that anyone would ever do that, because we know no one ever would. But these are all legitimate expenses. In fact, they are probably a lot of the same things that you would incur, same expenses you would incur if you were an employee, but you just couldn't write off. I mean, if you go to work and you're at lunch and you get an email, and that comes through, your company doesn't supply you with a company mobile phone, because everybody would just use a personal one anyway, because who the heck wants two phones? He wants two phones. I only got two, three. I mean, who knows how many phones you might have? You're using your personal phone for that, right? There might be, I mean, to some extent, there's a cost with that. Depreciation on the phone. It wears out over time. If you get, maybe you would have gotten 50,000 emails this year, but because you were you had your work account attached to that, you got 150,000. Burns out the processor inside. I don't know, I'm making this up. But there is, to some degree, there is a cost there that doesn't get accounted for or expensed if you're an employee. But if you are an independent contractor, you can bet that you're going to write off that cell phone. The purchase of that cell phone, the service attached to that cell phone, any apps that you bought to put on that cell phone, anything that you could reasonably attach to that business activity in any way, even if, there might have been a thread of personal use in there. I mean, like, to what degree are you going to try and separate those out? I mean, there's a certain point where you just kind of lump it all together and throw it on there. So keep that in mind. That is the basis for the alternative income documentation programs that we're going to get into when we come back. But let's go to take a break here, and we'll be back.
All right. You're listening to HomeWise. That's Michael Midget. I'm Stal Ponticus. Glad that you're along. We will take a quick break and come right back. Welcome back to HomeWise. I'm Stal Ponticus with the host and creator of the show, Michael Midget, here with me in the studio. Michael, continue your conversation.
Yeah, so we've been talking about self-employed people, how their income gets calculated, how they're discriminated against when it comes to income calculations, and just some of sort of the things of why, what that looks like, why that is. And we're finally getting to now where we're going to talk about what we can do about it if you are one of the people that falls into that category that struggles with getting qualified as a self-employed person because of the nature of your self-employment. Maybe it's a new self-employment. Maybe it's a self-employment where you're aggressive with your deductions, legally, of course. Not suggesting anyone would commit tax fraud or anything like that, but there's leeway in, the law is, as black and white as we might try and make it. It's really shades of gray. So it's what you can back up, what you can document, and that. And some people do a better job at that. Some people are more aggressive than others with that. Some people are just more efficient, So maybe, you're just not a great business person, and it costs you more to do business than it might be for someone who can squeeze more net out of or produce that same revenue with less expenses.
Someone who's more frugal.
Yeah, so we were talking about the difference between, why, if I'm a 1099 versus a W-2, when I go to get a loan and I'm a W-2 employee, I just give you the W-2 and you figure my income with that. But if I'm 1099, you can't just give me the 1099 and divide it up, because you have expenses associated with that. You're likely making deductions from that. So when we going to need that tax return, if we're doing this under conventional guidelines, we're going to see those deductions. We're going to use that net income for that. And so whether it's on a Schedule C, like a 1099 might be, or if you have a separate entity set up and that like a corporation or an LLC, and there's a separate tax return being filed for that. We're going to be looking for 2 years of the activity. We're going to look at the bottom line net income number, and there's some add backs and some adjustments that can be made to that number. It's beyond the scope of what we're discussing today, but just understand that we're not using, for conventional, normal, typical guidelines, we're not using the top line number. We're using the bottom line net income number. We're going to average those over 2 years, and that's what goes on the application. So alternative income documentation, what does that mean? So it's an alternative to what would typically be done under conventional guidelines. Okay. So when I say that, I don't mean subprime. Okay. So this is not a throwback to subprime under a new name. It's not no income verification, because we're not just say, hey, how much do you make? And you're writing it down on the loan application without scrutinizing it at all. We are alternatively documenting income that we are able to prove the existence of, right? So if we're able to prove the existence of a business, because it needs to be a business activity, you can't be a wage earner and use these methods, right? So now with a 1099, of course, that doesn't make sense, because if you were a wage earner, you'd be getting W-2, not a 1099. But in addition to 1099, there's also the bank statement version of this. And sometimes people will come to you and, I have a job, I work at XYZ company, I'm a normal, regular employee, but I don't make enough for what I'm trying to borrow here. Can I use bank statements? I can show more income than what I'm making at the work here, because I do side cash jobs on the side. I pay okay, heard enough. No, it doesn't work like that, because we have to prove the existence of that business. That's going to require some type of a legal filing, a legal something, right? And so this all stems from ability to repay rules, right? You can't make loans to people that you can't reasonably demonstrate an ability to repay, because if you don't believe that they have the ability to repay, why are you making them the loan? Well, it must be because you want to take their property. And that's a bad thing as a systemic effect. Back in the Great Recession, not because banks wanted to take all these properties, but there were too many loans written on the books. It started a cascading domino effect that began with the existence of these non-income verification loans. So, but that is not what we are talking about. It's different. It's just a common sense approach to documenting what we're able to prove the existence of a business there. So, for example, with the 1099 program, instead of, here, give me your tax return, and we're looking for the net income figure on Schedule C, and we're going to average that over 2 years, you can just give me the 1099. And you don't have to give me the tax return for that. And we can just use that 1099 figure. Now, we don't use that 1099 figure dollar for dollar, because, again, we know if we got the tax returns, we didn't ask for them, but we know if we did, that there's likely going to be some expenses on there. And so we do need to assess some sort of an expense factor from that. But to make it simple, and to, just because, millions and millions of these loans have been done and looked at and performance modeled and all that, we're able to determine that if we assess an expense factor of, say, 25% of what you brought in, so your net profitability is 75% of what you make, that's a good, safe number. It's a conservative number. It in most cases might accurately reflect what someone is actually making and earning. And it, from a loan performance and a do good things for all parties involved, it works. Empirically works. We have the loan performance data to back it up. This idea works. Okay. To which you might say, well, I don't claim 25% in expenses. In fact, I don't claim any expenses at all. Yeah, I got that 1099, but I just stick that number on because I don't have a tax guy. But I'm saving a couple $100 a year by filing my own taxes. So I just stick the number on the form, and that's what I pay tax on, even though I guess now you're telling me I could deduct things. Well, if that's the case, then you wouldn't use the alternative program. You just go with the full doc, like normal, typical everyday program, because that number, your net is the same as your top line gross because you didn't have any deductions. That's okay. That's okay. The IRS will take more tax dollars than you owe if you're willing to send it to them. It's just, when you calculate tax liability, that's just a minimum figure. Like, they'll take more, right? And people that don't feel that they pay enough taxes, feel free to send in more. Feel free to send in what you think that you ought to pay. But most normal, logical, sane people that actually earn the money that they make don't do that, right? And so if you fall into the previous category, though, you just use your regular tax return. But for 1099, we just assess a 25% expense factor for that. If you are a business owner, so it's not a 1099, but you actually, own the business and you employ yourself, even if you have yourself employed. So if you create an entity like a corporation, so if like for me, I'm a corporation, had a corporation for 26 some odd years, Shelter Mortgage Incorporated. Go look it up. It's a C Corp, and I am the president, CEO. I'm an employee of this entity, right? I'm the only employee of the entity. I'm the only board of directors. I'm the only officer and all of that, but I am still an employee of the company. I still fall into this category of self-employed because, remember, I own more than 25%. So that's where you take the tax returns of the company and you need my personal returns. When you get my personal returns, you'll see that I get a W-2 and a pay stub. So I have to document both things there. But let's say that for whatever reason, if I was going to go out and get a loan and I couldn't qualify under normal circumstances with that, I could use the bank statement version of this same loan program. Now, if I do that, then the expense factor goes up to 50%, right? Now, anybody that runs a legitimate business, like full on, I got a store, I got an office, I've got employees, I got computers, I got overhead. You know that word, overhead, like, holy cow, I made this much, but I only took home this much. Where did it all go? It went to overhead. That's where it went. If a business nets, some business models are built on netting 2, 3, 5%. If you're doing, depending on how big you are, maybe 10%. By the way, the bigger you get, the smaller that number gets. When you get into hundreds of millions of dollars of revenue, those numbers will tend to go down. But it's industry by industry, manufacturing versus a tech company, you're going to have different metrics with, with all of those things. But in this case, you just get all lumped together. And if you brought in $1 million, we'll give you, on bank statements, demonstrate $1 million in revenues that we just take 50% of that number. And then that's what would use to get average. So obviously there's more to all these things, but there are alternatives out there that are based on common sense, still documenting that there's cash flow, money coming in, and with a legitimate, proven existence business, that all works and it makes sense because theoretically it demonstrates ability to repay, demonstrating cash flow, and it all works out. So depending on where you fall there, that's the kind of determination I make when I get a call in. So people will call me all the time, to get, so-and-so sent me over to get a pre-approval letter. I got to get pre-approved. I want to buy a house. And they have a story they tell me, and I love to hear the story because it helps me get into the frame of mind that it takes in order to do the level of job and service that I want to do for everybody, treat everybody the same way that I would treat myself if I were doing my own loan or family member or whatever. And so, they tell me what's going on, and when part of that conversation is going to involve where you work, What's the nature of that work? How do you get paid? How much do you get paid? And so when that conversation dives in, that's where the questions come from. But I try to get as much as that up front so that I can give an accurate idea of what someone is going to be looking at when they're going through. So the best thing is to just reach out and call. You can catch us here at the radio website, HomeWiseRadio.com. My mortgage website, GoShelter.com. Got all my contact information on there. Or if you're driving around, feel free to call 314-275-0314. You can call it or text it.
Great. Thank you so much. That wraps up this edition of HomeWise. That's Michael Midget. I'm Stal Ponticus. We're thrilled that you joined us for this week's edition of the show. Hope you join us again next weekend for another edition of HomeWise.
Thanks, Stal.
Loans and loan information provided by Shelter Mortgage, Inc. Visit us at GoShelter.com and MLS number 192609. A Missouri residential mortgage licensee and equal housing lender. Call 888-497-2558 for additional cost information. Other restrictions may apply.